We're here at Profimex Strategy Talks, where we interview some of the industry experts from around the world about everything that has to do with real estate. And we're here today with Max Czerkansky from Trion Properties, or Trion, who is based in
Miami now.
In Miami now, after a long time in the West Coast. And you'll tell us a little bit about how you got there. And our focus of our conversation today is the U.S. macro markets, but we're going to really focus on multifamily, which is your expertise, right?
Correct.
So maybe before we start, can you tell us a little bit how you got to be a leader in multifamily investments, more on the East Coast, but all around the U.S.?
Yeah, sure. Leader's a big word, so thank you for that. We started back in 05, 06. I started as a broker straight out of college in 02. I went to go work at Marcus & Millichap. I was brokering multifamily in the San Fernando Valley in Los Angeles. My partner Mitch and I are childhood friends. We were just talking about this last night, that I was actually at his bar mitzvah.
Wow.
So we go back 32 years, 33 years.
Do you remember his speech from the bar mitzvah?
I do not.
Okay. We'll ask him later.
Exactly. We'll have him recite it again. So, we were just having dinner one night and we said, well, how do we get to the other side of the table? We're doing great. We're in our early to mid 20s.
And can you explain what it means getting to the other side of the table for our listeners that might not be part of this industry?
Sure. So how do we go from brokerage, from being in the services business, to actually owning the real estate? Because when we were having that talk that night, we were saying yeah, we're doing great, but it's really our clients who are making all the money. So how do we do that? How do we get into ownership? And that's really the ultimate goal anyways. That's what we always wanted to do, even when we started on the services side of the business. And I had something coming up at the time. I was working on something that looked interesting, so we bought it direct. It was just a little 12-unit building in a suburb of Los Angeles, and we really liked it and got really excited about it. And then we bought a 34-unit building and a 44-unit and then an 80-unit. And
the rest of history.
And the rest is history. A year later, we started our own company, and we left Marcus. He was on the debt side at HFF. I left Marcus. He left HFF. And we started Trion. We bought a portfolio. We built a portfolio through that cycle. We bought one by one.
The cycle that started when?
Well, we started buying in 05. That cycle, I would say, started, I don't know. I mean, you could theoretically say mid-90s. You could say in 01.
Yep.
I would say more like mid-90s. So, we were buying at the tail end of the cycle, but we were fortunate. We had very good timing. And we sold the whole portfolio in 2008. The writing was kind of on the wall with what was going on.
So we're talking about the global financial crisis of 2007, 8, and 9, and you were able to foresee it and sell on time.
We did. We never thought it was going to be as bad as it was. But subprime lenders were folding. The market was going in the other direction. And we said, why don't we just sell everything and just start from scratch? We were just, it was easy to do at that time. We were just a few guys in a small office with no overhead. We weren't a 100-person organization where we would have to really think about doing something like that and what that means.
Well, things are very different right now, and
Correct.
We'll talk a little bit about how significant your organization is right now. For listeners who don't know what multifamily is, it's not as common in Europe and in Israel. Can you tell us a little bit about what multifamily is, and maybe talk a little bit about agency lending and why that's such an important part of the success of the sector?
Sure. Multifamily real estate is buying apartment buildings, which is an entire building of apartments that is for rent. And yes, I'm aware that the U.S. is somewhat of an anomaly in that industry, which is just bizarre. And most of the world builds their buildings as condos. They sell individual units, and then a lot of investors will oftentimes buy those units, or a former homeowner will rent them out. So yes.
So in many places around the world, they're individually owned by landlords who own 1 or 2 or 3 apartments.
Correct.
Not necessarily in the same location. But in the U.S., multifamily is a whole building, sometimes a few buildings in the same location, owned by the same owner, which usually is either a person or a company or a fund that owns the building.
That's correct. That's correct. And it's a huge business. It's a multi-billion-dollar industry in the U.S. We're in the value-add space, so we typically buy something that was built in, let's say, the 1980s, 1990s, maybe 2000s, hasn't been touched in a long time. Somebody's owned it for 10, 15, 20 years, and they haven't done much to it. They've been asleep at the wheel with what's going on with growth, or they just don't want to invest money back into it. So we'll buy it, we'll invest millions of dollars into the asset, and we'll modernize it to the best of our ability, and we'll create a product that's priced below brand new construction. So we'll give people something that feels new because it's newly renovated, and it's a discount to brand new product by usually 15 to 20%.
What's the kind of improvements that are the most common, and maybe talk about some of the trends? I remember there were years where yoga rooms were very popular, or kind of a pet bath area, things like that. Can you talk a little bit about what you see as the more consistent renovations or improvements, and what are the things that are more of a fad?
Sure. I would say that pet bath, the yoga thing, that's probably a little bit more of a fad. I think a lot of those yoga rooms are now being repurposed into other fitness type facilities. Like what we'll do sometimes if we have a lot of space, like in our larger communities, we'll do a weight room, and then we'll do something called a cardio lab where we just put cardio instead of yoga, because yoga's, what's a yoga room? It's an empty room. So we'll actually put machines in there.
That could be a name of your next book. What's a yoga room? It's just an empty room.
Exactly. It's a room to put your mat.
Yes.
It smells good. So that's actually a big part of what we do, right? So we'll buy these older properties and we'll turn a rec room, which is typically not used as much anymore. It'll still get more use than a yoga room. You just have to modernize it, right? You have to get nice furniture, nice couches, great tables to have a party, and chairs and all the nice furniture. You want some natural light in there if you're going to continue to use it as a rec room. We, on the other hand, often take a rec room offline, and we'll turn it into fitness or something more usable than just a rec area for congregation and parties. We'll usually take a pool area, we'll modernize it, we'll put in brand new pool furniture, we'll maybe put in some cabanas and make it like a resort type pool. In-unit amenities, I think to this day, the number one in-unit amenity is a washer dryer, without a doubt.
I get that. As a parent, sometimes I think my whole job is really just washing and drying all day long. It seems like it just keeps on working. So yeah, having that in your apartment is a huge advantage rather than going into the laundry room.
Exactly, especially in the US, where you have a lot of what's called garden-style communities, which are these open communities where you have to walk outside and you walk to a laundry room, and if it's raining or if it's cold, nobody really wants to do that.
Yep.
And shove quarters into a machine or use a credit card. Everybody would much rather just have it right next to their kitchen. You put the clothes in and out. You don't have to worry about paying every time you use it. It's in your rent.
Yeah.
It's the ultimate luxury, and it's a simple luxury.
And the COVID pandemic also changed a little bit the way that residents feel about what they need in their apartment. So maybe until COVID, there was even this move towards smaller apartments, kind of like these micro mini apartments with more amenities that are in the public space. But it seems like during COVID, people wanted to move back into their apartments. They were staying in their apartments, and they wanted to invest more in their experience in their apartment. Can you talk a little bit about how the COVID pandemic and those few years changed the appetite or the needs of residents in different apartment styles?
Sure. So I think there's definitely something to be said for micro units. You just have to underwrite it correctly as an owner if you're going to buy them. They should be in urban infill areas. For example, we recently looked at a micro unit property that was in foreclosure, and we have a relationship with the lender, and they called me and they said, "Hey Max, we've got this interesting property in Denver where we know you guys own, but it's in a suburb. It's a converted hotel, and the units are about 350 square feet." And I said, you know what, that's a pass, because somebody who lives in a suburb, which is an area like this where we are right now in Petite Tikva or in Bra'anana, where your offices are, micro units don't really make sense. But if you're in an area like a Tel Aviv, or you're in an area like Midtown Manhattan or Portland, downtown Portland, or San Francisco, where you can take an elevator downstairs and you've got 8 restaurants, 4 coffee shops, 3 fitness facilities, and all these different types of amenities, it makes a lot more sense because you are a matter of steps away from every urban amenity you can think of. That's the way to do micro units. You also want to underwrite it with a little bit more vacancy because, somebody who's renting a 300 square foot unit, 400 square foot unit, they're typically not there for 5+ years.
Yep.
So you're going to get a little bit more turnover, you're going to get a little more cost. So you just have to underwrite it correctly, buy it correctly, and you can do well with it. But to answer your question on amenities and in terms of in-unit amenities, I think if you have like a little bit of a cove inside the unit, like a nook where you could put a desk and a home office, I think that's just fantastic because a lot of people are working from home. We'll see where that fad goes, but there's an element of it that is here to stay. Like, for example, our accounting department is in LA. I really shouldn't be saying this on camera, but I'll say it. It is very, very hard to hire accountants 5 days a week in the office because to this day, most US businesses will give accountants some sort of remote or hybrid schedule. You think a lot about what they do. They sit there at their computers and they're just doing accounting. So whether they're doing it in the office or doing it at home, accounting's accounting.
Same result.
Yeah, same result. It's not my personal belief. I think whether you're in accounting or in marketing or operations or acquisitions, whatever department you're in, you add to the culture of the business. So we're very big on in-office, but not everybody sees the world the way that I do. So
you said before that you're a vertically integrated company. Can you explain a little bit what that means? And also, if you can touch a little bit about the difference between value-add investments and core and opportunistic investments.
Sure. Vertically integrated in our business means that we do property management in-house. We also do project/construction management in-house. And that's important, and that's, let's say significant because a lot of our competitors in the space, they outsource that. So they hire a property management company like a Greystar or an Asset Living, and they outsource the operations of the business. That's pretty unique to our industry, to real estate and to multifamily. You can't really think of too many other industries where you're outsourcing your operations. And that's why we like to bring it in-house because we feel like every other industry in America, in the world, it really should be an internal function. Mm-hmm. And I'm not knocking it, with all due respect to all of our peers, and we have a lot of friends who outsource, and there are pros and cons to it, but we believe that you get much stronger operations and you have a lot more control when you have end-to-end operations in-house. It's your talent, your software, your everything.
So obviously, the returns on an investment has to do a lot with the price you pay and the price you get to sell it for, but the day-to-day operations, the NOI, the net operating income is extremely important because that also determines your exit price. So being able to control your operation, being able to control how much you pay and what's the kind of income that you get is extremely important. What you're saying is when you're vertically integrated, you're able to do that in-house and have more control over that and have more effect and are able to change the route of things.
That's correct. We have everybody in-house. So from the head of property management to all the regional managers, the construction managers, everybody who works on site, from the community manager to the assistant manager, the maintenance techs, the maintenance lead, everybody is an employee of Trion Properties, and we take a lot of pride in that. So, in operations, the most important thing is your people. It's at the end of the day, it's a services-based business. So you have to hire the best people, you have to train the best people, you have to have these programs, and it's very, very difficult. Anybody can buy cheap and sell high, but it's what's in the middle that really counts.
So if this was a movie, we would do a flashback scene right now. So let's go back to kind of the end of the global financial crisis. We're in 2010, 2011, and we start this very long period of a low interest rate. So the interest rates, the Fed interest rate gets almost to zero. And then we come into the pandemic in around 2020, and inflation starts roaring. And as a result of that, the Fed starts increasing interest rates. And then we're in this very sharp period of increasing interest rates, and we get to an interest rate from 0 to 5 very quickly. And only in September 2024, we started seeing an ease of that. Can you describe a little bit how the interest rate has affected multifamily industry over the last 3 or 4 years?
Sure. It's affected interest rates have affected multifamily very negatively, unfortunately, because we're a very interest rate sensitive business. It's a leveraged business, right? So the interest rate that you pay on your loan is going to affect your pricing. When interest rates are very low, cap rates are low. When interest rates are high, cap rates are higher. So unfortunately, values have gone down with cap rates going up. A lot of the money getting sucked out of the system with higher rates and quantitative tightening has made rents go down. Rents peaked in about 2022. There was a lot of irrational exuberance with rents going up 10, 15, 20% every year. Vacancy was 1%. I mean, it felt amazing. It was the best operating environment we've ever been in. It was just phenomenal. And then everything kind of came to a screeching halt, and now we're, working through it. It's created a lot of problems in the industry because you've got maturing loans that are hard to refinance out of. You've got rate caps that need to be purchased, which are in the money, which are very expensive, oftentimes $1 million+ to buy an interest rate cap, which is a hedge to keep your interest rate low. And it's been a lot of headaches the past couple of years, but hopefully help is on the way soon with rates going down a bit.
So adding to the financial challenges of financing the property you own or you want to buy, there's also some operational challenges. Most of them have to do with the high inflation, which means that your workforce and your expenses are very high. And what about rents? How have you seen rents over the last 2-3 years, and where do you think they're going?
Great question. So the operational challenges are, yes, as you pointed out, with inflation. There has been a problem, especially in our model, right, where you renovate and you're making something really, really nice and you're expecting somebody to pay a premium for that. Well, if the cost of everything else in someone's life has gone up significantly and it's outpaced their wage growth, then they're not going to spend the extra money on stone countertops and new kitchens and all these wonderful things that we're doing. So if you can't get the premium or your premium goes down significantly, the return on your investment goes down and it's no longer feasible to renovate, or you have to do some sort of a makeshift renovation where it's a little bit more what we call a partial. So instead of spending $15,000 to $20,000 a unit, you're spending $7,500 a unit, $10,000 a unit. You're doing a lot less, and instead of charging $200 a month for a renovation premium, you're charging $75 a month or $100 a month. So that's a big part of what we're doing. And then on the macro side with rents, yes, as you pointed out, that the inflation has been a problem and rents have started to go in the other direction. And it's not just inflation, it's also because of supply. Multifamily apartments, it's just like any other product. It's beholden to the macroeconomic factors of supply and demand.
So in 2018, 2019, interest rates are very, very low for construction loans as well. So we see a lot of developers going into the market, starting to build, which means that those assets, that inventory, it has been coming into the market and are really expecting still a lot of it to come into the market over the next 6 to 12 months.
Yeah, so 2018-19, interest rates were low, not nearly as low as they were in 2020, 21, and early 22. But yes, I mean, the market was strong. It wasn't like blowing up and, it wasn't in bubble territory. The market was strong. People were building. That was a great period. I actually very much enjoyed doing business in the 2014 to 2019, 2020 period. And yes, there were a lot of developers buying sites, getting things planned, and then COVID hit, and that turbocharged everything because of interest rates and then rent growth, which was being caused by stimulus. And a lot of units were being delivered, and all those units that were delivered in 2022, 23, 24 have made rents go down because it's a record-breaking amount of supply. The amount of supply delivered in 23 and 24, I believe, is the most since the 1980s. And the 1980s are known for a massive supply boom. Dallas, Texas had something like, to this day, 30 or 40% of its apartment stock was delivered in the 80s. Dallas has more apartments that were built in the 1980s than the entire city of Austin has to this day.
Wow. So, but not every city and not every area, not every state is the same, right?
Correct.
So many states have oversupply, and then some other areas are still grappling to get more units into the system. So can you talk a little bit about this differentiation of areas and why it's so important to be an expert, not just in finance, not just in multifamily, but really knowing the area that you're investing in?
Of course. Well, that's real estate, right? Location, location, location. And a part of that knowledge is knowing the politics and understanding the regulatory framework in a place that you're investing and you're buying and you're operating. You should know the regulatory framework, not just from a landlord-tenant perspective, but you should know how easy or how hard it is to build new units. That's going to be ultimately your competition. So as a rule of thumb, painting this with a pretty broad brushstroke, if you're in the red states in the Sun Belt like Texas and Florida, it's a much easier operating environment in terms of landlord-tenant relations, that regulatory framework. So it's much easier to evict. If someone isn't paying you rent, you've got a lot more remedies as a landlord. But at the same time, because it's so business friendly, it's much easier to build, right? So you buy a development site, you go to an architect, you get it drawn up, you submit your plans, you're pretty much certain to have a permit in 12 months, 15 months, whatever. In an area like, let's say, California, which is notoriously difficult to build. That's where I'm from. We've built there. We've done some development in California. I don't recommend it. You buy a development site, you go to your architect, and before you know it, you have a meeting with all the neighbors in the area. Your property rights are pretty limited because people can opine on what you can and can't build. I remember I had one meeting during COVID. It was on a Zoom call. You couldn't do them in person at the time. And we had one of the neighbors asking if we could chop the building down into a lower building. He said, 4 stories isn't going to look nice in our area. Can you make it a 3-story building? And we said, no, we can't make it a 3-story building because that no longer makes it feasible. We can't do this at a loss. We paid for 4 stories. We're building 4 stories. And these are the things you have to go through in California. And it could take years and years just to put a shovel into the ground. So I think you kind of get it.
So maybe let's shift a little bit into the opportunities that we're seeing right now. So we're in a pretty fragmented market right now. We're not seeing enough meetings of buyers and sellers. So the transaction volume has been pretty low over the last year, even though we've seen a little bit of a pickup over the last few months. But there's also a lot of dry powder, money sitting on the side, waiting for opportunities. How do you see the opportunities right now?
To be honest with you, we really like the light value add business right now. We're finding the most opportunity and the best risk-adjusted return. That's very important, is risk-adjusted return to be in that sector. So we recently bought, as an example, a property in Atlanta. We bought it in fourth quarter 2024. It's built in 03. It's beautiful. There's not a lot we need to do with it. We're going to make some light upgrades to the units, and the property runs very well. We bought it at a high cap rate, at a 6.25 cap, which is phenomenal for 03 vintage in a good area in Atlanta. And we got our interest rate right when we had that big bond rally last summer. We rate locked when the 5-year treasury was at 3.5, so we closed at 5.2%. So we got a 6.25 cap rate, 5.2%, 6.5% plus cash flow out of the gates. And it's a very easy deal to operate, and we can organically raise rents as we do these renovations.
So that's a kind of an example where you're going to do light value add. You're not going to put significant amount of money because right now you can't push rents up enough for it to make sense, but maybe down the road you'll do more.
Yeah, so if you look at it, so we've had some lenders call us and some brokers who are working with foreclosures and things of that nature, lender-driven short sales. And if you're honest about the underwriting, if you're really doing everything correctly and you're looking at what it's going to cost you to do the exterior, what it's going to cost you to do the interior, the evictions you're going to have to deal with, and what we would call execution risk, and actually like doing all that work, you kind of wind up in the same place from a return perspective as buying the '03 property where you don't have to do a whole lot. So why do all that work? Why take the risk of doing all that construction and those evictions and all that headache when you're just going to wind up in the same place? So as much as we love doing that, and as well as we did in 2010, 11, 12, 13, doing all that, it was an amazing business. We find it right now not to be a smart risk-adjusted strategy.
It sounds like between 2010 and maybe up to 2019, it was, I don't want to say easy to make money off of investing in multifamily, but it wasn't a very, or for many developers or many owners, it wasn't a very complex tax because of low interest rates and increase in rent. But now it's a very different environment. So one of my worries is that potential investors are looking at the not so far future, maybe 5-6 years ago, where a lot of people that might not have a lot of experience doing real estate were still able to be successful and get some good returns, are trying to stay in the market right now and offer the same type of investments. But investors should really be wary of the type of managers they work with.
Sure. I would say the peak of what you just described, which is incompetent people making money and great returns, was 2021, 22. The 2014 to 2019 era, depending where you were doing business, so we were on the West Coast, it wasn't a super high growth part of the country. It did have growth. Cap rates weren't really coming down that much during that period. So for us as a value add operator, we don't need that much growth because we're taking rents at point A, we're taking them to point B, and then we can exit at cap rates on that day. We're not underwriting cap rate compression. We're just underwriting where are the cap rates, how do we go from point A to point B and sell, right? Buy at a 4 cap, take it to a 6 cap, sell at a 5 cap. That strategy worked very, very well for us many, many times over. And we just can't do that right now because cap rates went up, rents went down, and you just have a massive headwind. And for groups like ours, we don't need a tailwind, we just need no wind. So yes, unfortunately right now we have a huge headwind with the supply, with the macroeconomic issues, with interest rates, and the opportunity right now is just to hold and not sell and buy more at low prices and sell into a better market.
Shifting gears to a personal question,
Sure.
How old are your children?
My kids, I have 2 boys, they're 8 and 6. Isaac and Benjamin, very Israeli Jewish type names.
Would you want them to be in the real estate business when they grow up?
I would want them to do whatever makes them happy. Of course, I'd want them to be, I want them to be financially capable and for them to be able to pay the bills. And ultimately, I just want them to make them happy. And if that's real estate, great, I'll help them. And if not, whatever.
Any tips for a young professional who wants to get into this industry, either as a broker or working for an owner like you?
Yes, I would say do one or the other. I think those are both 2 great places to start. If you're coming out of college or you're early in your career, look for an owner like us or a big owner where you can go work as an analyst, either on the acquisition side or the operation side, and you can really learn the business. Or you could start your career as a broker and learn on the services side. And one of the best ways that I learned as a broker was talking to my clients and spending a lot of time with my clients and saying, hey, how do you do this? Like, what's your strategy? How do you make money in this business? And you'd be amazed how much you can learn.
Is there anything you miss about your days as a broker?
Sure. I miss being on the phone all day long and just working on transactions all day long. Working on transactions is a lot of fun. And it's wheeling and dealing, and you learn a lot about human psychology, talking to buyers and sellers and pricing and emotions, and it's a fascinating business.
well, wait until your kids are 12 and 11. They're going to be calling you all day long, so you'll be busy on the phone as well. Thank you very much for your insight today. I think we have a few exciting years in front of us, and we would be glad to hear your thoughts again, maybe in a few months.
Yeah, I'll see you soon.
Thanks a lot.
Thank you.